$850 billion. That's not a theoretical number on a spreadsheet. It's a loaded financial weapon pointed directly at your mortgage rate, your refinance options, and your ability to buy a home in America. And as of right now, the finger on that trigger belongs to the People's Bank of China. Here's what most people don't understand. For the first time in modern history, the threat of a massive treasury dump has moved from conspiracy theory to mathematical certainty. We're watching a geopolitical divorce play out in real time, and it's going to fundamentally reprice every single asset you own. Your 30-year fixed mortgage rate is about to detach completely from what the Federal Reserve does and skyrocket based purely on supply and demand. If you thought 7% mortgage rates were painful, you're not ready for what happens when the largest foreign creditor to the United States walks away from the table. Before I show you exactly how this destroys your buying power and what you can do to position yourself defensively, make sure you're subscribed so you don't miss the daily updates on this financial war. And comment below with gold or dollar to let me know which one you trust more right now. Let me break down the math that Wall Street doesn't want you to see. The headline number everyone quotes for Chinese holdings of US Treasuries is around $760 billion. But here's what they're leaving out. When you add in agency debt, the bonds from Fannie Mae and Freddie Mac that back your neighbor's mortgage, China's total exposure jumps to $850 billion. That's the nuclear leverage Beijing holds over the US economy today. For 2 decades, this relationship worked perfectly for American consumers. China sold us cheap goods. We paid them in IOUs called treasury bonds. They recycled those dollars back into our debt market, which kept our interest rates artificially low and their currency competitive for exports. It was the greatest subsidy to the American standard of living in history, but the 2026 trade war just shattered that entire system. When the US slapped 60% tariffs on Chinese exports, we essentially told them their dollars aren't welcome here anymore. So logically, they've stopped recycling those dollars into US debt. In fact, they're actively liquidating their existing positions. The latest Treasury International Capital data confirms China has been selling US assets at the fastest pace since 2015. This isn't a random market fluctuation. This is a strategic state-level decision to de-dollarize their entire economy. They're selling US Treasuries and using every dollar of proceeds to buy physical gold bars by the ton. The People's Bank of China has added to its gold reserves for 28 consecutive months. That's a record streak. They're trading paper promises from what they now view as a hostile government for Tier 1 collateral with zero counterparty risk. They watched what happened to Russia's reserves in 2022 when they got frozen out of the global system, and they're making damn sure it can't happen to them. But here's the problem for you. It's not that China is buying gold. The real issue is who's not buying the bonds they're selling. The US government is running a $2 trillion annual deficit right now. That means we need to sell billions of dollars in new bonds every single week just to keep the lights on in Washington. In the past, China would show up to those bond auctions and buy a massive chunk without hesitation. Now, they're not only absent from the auction, they're actively dumping their old bonds into the secondary market at the same time. This creates a supply glut, more bonds for sale than there are buyers. When supply exceeds demand, the price of bonds crashes. And here's the part that directly affects your mortgage in the bond market. When the price goes down, the yield, the interest rate goes up immediately. This is why the 10-year Treasury yield keeps spiking even though inflation is technically cooling. The market is waking up to the fact that there's no marginal buyer left to absorb the tsunami of US debt. The Federal Reserve is doing quantitative tightening, which means they're selling bonds, not buying. US banks are already drowning in government debt and sitting on unrealized losses. Japan is struggling to defend the yen and has turned into a net seller of treasuries as well. That leaves you, the American domestic investor, as the only one left to fund the government's spending addiction. But to convince you to buy a 10-year bond, the government has to offer a much higher interest rate than before. This forces yields higher across the entire curve, impacting every loan in the economy. And the most direct impact, the 30-year fixed mortgage, which tracks the 10-year Treasury yield almost exactly. Do the math with me. If China's selling pushes the 10-year yield to 6%, mortgage rates will mathematically hit 9%. We're watching a complete decoupling of mortgage rates from the Fed funds rate. The Fed could cut rates tomorrow, but if China dumps another $50 billion in bonds that same week, your mortgage rate still goes up. This effectively neutralizes the Federal Reserve's ability to rescue the housing market. We're entering what's called fiscal dominance, a regime where debt supply matters more than monetary policy, and Beijing knows exactly how much pain this causes the American middle class. They understand that housing is the primary engine of the US economy and the primary source of household wealth. By engineering higher interest rates through bond selling, they can trigger a recession in America without firing a single shot. It's asymmetric financial warfare, and it leverages our debt addiction directly against us. The timing tells you everything. This accelerated selling aligns perfectly with the semiconductor sanctions. It's tit-for-tat retaliation. You cut off our access to advanced chips, we cut off your access to cheap credit. The difference? China can survive without cutting-edge NVIDIA processors for a few years. The US economy cannot survive 9% mortgage rates for a few years without a massive systemic collapse. The commercial real estate market is already on the edge of insolvency due to refinancing risks. A further spike in rates from foreign selling would be the final blow to office towers across America. We're talking about trillions in real estate value getting wiped out purely from a shift in bond yields. And the Treasury Department is powerless to stop it unless they force the Fed to restart the money printer. But here's the trap. If the Fed starts printing money to buy the bonds China is selling, inflation explodes again. We'd be monetizing the debt of a foreign adversary, destroying the purchasing power of the dollar in the process. This is the impossible choice Beijing has engineered: either accept a deflationary depression or a hyperinflationary collapse. There's no soft landing when your biggest creditor decides to pull the plug. Now let me show you something the financial media is completely ignoring. The data reveals that China is using shell companies and custodians in Belgium and Luxembourg to mask the true scale of their selling. The official $760 billion number is almost certainly an understatement. They're using every rally in the bond market as an opportunity to unload billions more in exposure without crashing the price all at once. This puts a hard ceiling on bond prices, which means interest rates have a floor they cannot break through. The days of 3%, 4%, or even 5% mortgages are gone for a generation. We're reverting to the historic norm of high capital costs, and is driven purely by the loss of foreign subsidies. The exorbitant privilege of the US dollar, our ability to print the world's reserve currency and have foreigners eagerly lend it back to us, is being eroded trade by trade, bond by bond. If the world no longer wants to hold our debt, we have to pay a massive premium to fund our lifestyle. And that premium gets paid by you in the form of higher credit card APR, higher auto loans, higher mortgages. You're paying the geopolitical risk premium every single month, whether you realize it or not. Here's what makes this truly dangerous. The financial system has a hidden piece of plumbing that just ran completely dry, and almost nobody noticed. It's called the reverse repo facility. For the last 2 years, this facility held over $2 trillion in excess cash. It acted as a massive shock absorber that allowed the Treasury to issue trillions in new debt without instantly breaking the market. When the government needed to sell bonds, money would flow out of this facility to buy them, keeping rates relatively stable. But as of this month, that $2 trillion cushion has been depleted to effectively zero. The easy money that was absorbing government debt is gone forever. Now, every dollar the government borrows has to come directly from the existing liquidity in the banking system. And this is happening at the exact same moment China is dumping $850 billion. It's a supply shock meeting a liquidity cliff. Without that reverse repo buffer, bank reserves are becoming scarce. This drives up the cost of overnight funding and puts immense pressure on regional banks that are already struggling. We're watching the unrealized losses on bank balance sheets metastasize into a solvency crisis. Here's how it works. When bond yields rise, driven by Chinese selling, the market value of bonds held by US banks crashes. According to FDIC data, US banks are currently sitting on over $600 billion in unrealized losses on securities. These are bonds they bought when rates were near zero, which are now worth 30% to 40% less. As long as they don't have to sell them, they can pretend the losses don't exist and hold to maturity. But if depositors get scared and start withdrawing money, banks are forced to sell these bonds at a massive loss. This is exactly what killed Silicon Valley Bank in 2023, except now it's not one bank. It's a systemic issue. China's selling pressure forces yields higher every day, which makes those unrealized losses grow larger. It's a deliberate strategy to weaken the American banking sector by attacking its capital base. Beijing understands that the US banking system is the Achilles heel of American power projection globally. If the banks are broke, they can't lend. If they can't lend, the economy grinds to a halt. And the Federal Reserve has lost its primary tool for bailing them out. The Bank Term Funding Program that saved banks in 2023 has expired and can't be easily restarted without triggering massive inflation. This leaves the Fed with a binary choice: let the banks fail or print trillions of dollars to cover the losses. Both options lead to the destruction of your purchasing power. Now let's talk about the petrodollar, because this is the second front in China's financial war. For 50 years, the petrodollar system ensured that oil was traded exclusively in US dollars. This created permanent structural demand for dollars from every country that needed to import energy. But China, the world's largest oil importer, is now paying for oil in yuan using currency swap lines with Saudi Arabia. This petro-yuan arrangement completely bypasses the US financial system, reducing global demand for dollars. Saudi Arabia is openly accepting currencies other than the dollar for oil exports for the first time in decades. This is a direct attack on the exorbitant privilege that allows the US to run massive deficits without immediate consequences. If the world needs fewer dollars to buy oil, they have less reason to hold US Treasury bonds as reserves. This structural shift aligns perfectly with the tactical bond selling we're seeing from the People's Bank of China. They're attacking the dollar from both sides. Supply side dumping bonds, demand side buying oil and yuan. It's a coordinated pincer movement designed to end the era of US financial hegemony. The impact is already showing up in what bond traders call the term premium, the extra compensation investors demand for the risk of holding long-term US bonds. They're realizing the US government has no credible plan to reduce the deficit or stabilize the debt. The only plan is to issue more debt to pay interest on the old debt. It's a classic Ponzi scheme dynamic. When the biggest foreign investor calls the bluff, the Ponzi begins to unravel. We're seeing failed bond auctions where the Treasury struggles to find buyers. Primary dealers, the big banks required to buy unsold bonds, are being forced to absorb them, clogging up their balance sheets. This limits their ability to provide liquidity to the broader financial system. It creates what's called a liquidity trap, where it becomes difficult to buy or sell large positions without moving the price violently. In this environment, a sudden geopolitical shock could cause the entire bond market to seize up. And if the Treasury market freezes, the global financial system freezes, because treasuries are the collateral for everything. The Federal Reserve sees this risk clearly, which is why they're talking about slowing the runoff of their balance sheet. They're terrified the bond market is on the verge of breaking, but slowing the runoff is just a band-aid on a gunshot wound. It doesn't solve the fundamental problem. The fundamental problem is this: the US government spends too much money and has relied on enemies to lend it back to them. Now that those enemies have stopped lending, the spending must be financed by inflation, which means the price of everything you buy, food, gas, insurance, rent, must go up to pay for the government's debt. It's a stealth tax levied on every holder of US dollars to bail out the Treasury and the banks. The Chinese government is effectively forcing the US to choose between hyperinflation and economic depression. They're betting that American politicians will always choose inflation to avoid short-term pain. And history tells us that's a very safe bet. So expect the Fed to eventually pivot and start printing money aggressively again. They'll call it yield curve control or market functioning support, but it's just money printing under a different name. This will temporarily stabilize the bond market and rescue the banks, but it will destroy the currency. We're looking at a future where the dollar loses value at an accelerating rate against real assets. This is why we're seeing what economists call a crack-up boom in the price of things that can't be printed. The stock market rises in nominal terms, not because companies are more profitable, but because the dollar is worth less. It's the Venezuela dynamic applied to the world's largest equity market. Investors are fleeing cash and moving into anything that will hold value against the coming devaluation. But the traditional safe asset of the last 40 years, the US Treasury bond, is now the source of danger. The classic 60-40 portfolio of 60% stocks and 40% bonds is structurally broken because bonds and stocks are now falling together. China has exposed the fragility of the entire Western financial system by simply stepping away. They've shown the world that the so-called risk-free rate is actually full of risk, and other nations are taking note. The BRICS countries are actively building alternative payment systems to bypass the dollar entirely. They're hoarding gold at a rate that suggests they're preparing for a new monetary standard, one where trade is settled in hard assets and commodities, not unbacked fiat currency. According to the World Gold Council, central bank gold purchases have hit their highest level in over 50 years. They're not buying gold because they like shiny objects. They're buying it because in a world of weaponized finance, gold is the only reserve asset that can't be frozen by sanctions. It's the only asset without a counterparty who can default on a promise to pay. The People's Bank of China has been leading this charge, aggressively converting trade surpluses into bullion. They're explicitly preparing for a post-dollar world where trade is settled in tangible value, not fiat promises. Pay attention to what central bankers do, not what they say in press conferences. They tell you that gold is a barbarous relic and that you should trust fiat currency. Yet they're stacking bars of this relic in their vaults at a frantic pace, completely ignoring their own advice. This is the ultimate insider trade. They're front-running the inevitable collapse of the bond market. They know the 60-40 portfolio is mathematically dead. For 40 years, bonds were the safe part of your portfolio that protected you when stocks went down. But in an inflationary debt crisis, stocks and bonds fall together, leaving you with nowhere to hide. This correlation destroys the diversification that retirement accounts rely on. We saw it in 2022, and we'll see it again on a much larger scale. Holding US Treasury bonds today isn't risk-free return, it's return-free risk. You're accepting a 5% yield on an asset that's losing 7% of its purchasing power annually to inflation. That's a guaranteed wealth destruction mathematically programmed into the investment itself. So where does capital go when it flees bonds and the dollar? It flows into hard assets, things that can't be printed by a central bank or debased by a politician. Productive farmland, energy infrastructure, industrial commodities, precious metals. These are the assets that survive currency collapse because they have intrinsic utility in the real world. China is securing these assets globally, buying mines in Africa, farmland in South America. They're trading depreciating dollars for copper, lithium, oil, and arable land. They're converting paper wealth into real wealth before the music stops. You should look at your own net worth and ask how much of this is paper versus real. If your entire wealth is in a bank account and a 401k invested in financial assets, you're vulnerable. You're the counterparty to the government's debt, and you're the one who will take the haircut when the system resets. The everything bubble was built on cheap credit. The everything bust will be driven by the repricing of that credit. As interest rates settle at a permanently higher level, valuations for stocks and real estate must compress. The price-to-earnings ratios of the S&P 500 can't stay at historic highs when the risk-free rate is 6%. The math doesn't work, and the reversion to the mean will be brutal for passive investors. This is why billionaires are quietly selling tech stocks and buying land and gold. They're moving down the risk pyramid, getting closer to economic reality. They understand that in a fiscal dominance regime, the volatility of inflation will wipe out speculative assets. You need to become your own central bank, holding reserves outside the banking system. This means physical possession of assets, not just a paper claim on an asset held by a custodian. If you own paper gold in an ETF, you don't own gold. You own a claim on a bank that in a systemic crisis may declare force majeure and settle your claim in worthless cash. The distinction between ownership and claims will be the most important financial lesson of this decade. China is taking physical delivery of everything they buy, leaving nothing in the vaults of London or New York. They're draining the physical liquidity from commodity exchanges, creating a squeeze. This leads to a bifurcation, a split between the paper price you see on TV and the physical price you'd actually pay to own the metal. Soon you won't be able to buy a physical gold coin for the spot price. Premiums will explode as scarcity of real metal meets panic from paper holders. We're already seeing this in the silver market, where physical premiums have detached from spot prices. The market is screaming that the paper price is a lie and physical supply is tight. Real estate faces a similar but more dangerous dynamic. It's a hard asset, but heavily financialized with debt. If you own your home outright, it's a decent inflation hedge. If you have a massive mortgage, it's a liability. And rising insurance costs plus property taxes act like a variable rate mortgage, even if your rate is fixed. Local governments, starved of revenue by the commercial real estate crash, will come for homeowners. They'll raise property taxes aggressively to fill budget holes left by empty office towers. This turns your home from an asset into a tax farm for an insolvent municipality. So even real estate isn't the perfect shield it was in the 1970s. You have to be more agile, more diversified, and more liquid than the average investor. And liquidity in a crisis doesn't mean holding cash. It means holding assets that are universally liquid across borders. Gold is liquid in every country, in every currency, in every crisis. It's the universal language of value that requires no translation and no electricity to transact. This is why the Chinese central bank is buying it. It's their insurance policy against system collapse. They're building a financial firewall to protect their economy from the coming currency wars. You need to build your own wall around your family's future. Don't wait for the Federal Reserve to signal it's time to protect yourself. By the time they admit there's a crisis, capital controls will already be in place. They'll try to lock you into the system with digital currencies and restrictions on cash withdrawals. Central bank digital currency, CBDC, is the ultimate tool for trapping capital in a failing system. It allows governments to impose negative interest rates and prevent you from moving money into hard assets. This is the endgame of the financial repression necessary to liquidate government debt. They need you to stay in dollars so they can inflate away the value of your savings. If you exit the dollar, you defeat their strategy, which is why they'll make it increasingly difficult. But the door is still open today for those who see reality clearly. You can still convert fiat currency into tangible assets without restriction or penalty. This window won't stay open forever as the crisis accelerates. The $850 billion sell order from China is just the first domino in a very long chain. It will topple the bond market, then the stock market, then the currency itself. We're watching the end of the post-World War II monetary order and the birth of something new. The transition will be chaotic, volatile, and destructive for those unprepared. But for those positioned correctly, it will be the opportunity of a lifetime. Wealth is never destroyed, only transferred from one set of hands to another. It's transferring from oblivious creditors to prepared owners. You have a choice. Will you be the creditor who gets paid back in worthless paper? Or will you be the owner who holds assets the world actually needs? The Chinese government has made its choice. They're moving with speed and conviction. They're betting against the dollar and betting on the laws of mathematics. I suggest you look at the math yourself and decide if you want to be on the other side of that trade. The time for complacency is over. The time for action is right now. Protect your purchasing power, reduce your counterparty risk, get out of the debt system while you still can. The storm we've been warning about is no longer on the horizon. It's overhead. The rain has started. And the shelter of the old financial world is leaking. Build your ark, load it with hard assets, and prepare for what's coming. If this breakdown opened your eyes to what's really happening in the global economy, share this with anyone who relies on the dollar for their financial future. Subscribe and turn on notifications so you're ready for the next development. We'll continue tracking the bond market, gold flows, and geopolitical moves daily. Together, we can navigate this collapse and come out the other side with our wealth and freedom intact.